how will insurance companies align themselves in the near future? So we are expecting interesting insights from Richard Wolf, Executive Director, ICESA. So, Richard, are you available and connected already? So, well, we are really happy to have you here, Richard. Thank you very much, and over to you.
Well, thank you so much, and thank you so much, Schumann, for putting on this conference for, I don't know how manyth time it is, and for bringing our lines of industry to the attention of the world. I mean, if you're anywhere on LinkedIn, this is a conference you could not have missed over the past time. Now, I'm going to share a couple of slides with you for the next 20 minutes, but I'm afraid, Robert, you gave away my clue. And my clue is basically the following. There are a lot of current developments in our industry at the moment. We all knew that. But I sleep extremely well. And I went to sleep on the 7th of November, 2019. I remember well, it was a Thursday, it was cold, and the world was well. And I woke up sometime in February 2022, early February. And I had a great sleep, and I looked at the statistics because that's the first thing I do when I wake up. And I thought, if these are the statistics, we must have had a fantastic time. And there will be a cloudless sky in front of us, because look at this. Everything is growing except for the loss ratio. Our business is growing. Our combined ratios are behaving very, very nice. So we must be in for, yeah, probably another 3 years sleep. That'd be nice. And then I picked up a newspaper. And nothing here is of, well, it's of a lot of excitement, but it would not bewilder you, because what I read in the newspaper are the determinants that we have right now. The remnants of the pandemic, it ain't over. Inflation, geopolitical tensions, and everything that stems from it. Now, does that have its influence on our business? Yes, absolutely it does. And just to name a few, and again, nothing is new. The whole new thing about this is that this has been termed by one industry practitioner as an additive crisis. We keep on adding up, whether it's the drying up of supply of free money, which makes it kind of hard to finance companies that are on the edge. Now, that's something we haven't had for such a long while, or something we really cannot control, like the lack of rainfall, the drought in the northwestern part of Europe over the last 6 months, which made it very, very hard to transport goods goods over the Rhine River. We are looking at an addiction to debt. When the times of free money were still here, remember those blessed times? Every company that had a little bit of self-respect paid back as much money as it could to its shareholders and filled up the coffers on debt because it was a lot cheaper. Now, guess what? Free money is over, inflation is up, and we are going in for a rough ride with a lot less equity than we could have had. Now, the good news to this, because I do not only want to sound as the prophet of doom and gloom, is that the liquidity coffers of companies are very, very full. And we need it. And we need it because of things like commodity pricing going through the roof. Now, Schumann is a German company. I think you used to import some energy from your eastern neighbors. Yeah, it's become a little bit more difficult. It's become a lot more expensive, and it has its repercussions in everyday life. And we are looking at the changing patterns of trade. And this has been going on for quite a while. Now, new words in the dictionary like friendshoring, nearshoring, reshoring, are starting to really disrupt the patterns of trade as we knew them as little as 5 years ago. Not only that, but if you look at all the supply chain disruptions and how you can get a container from Shanghai to Los Angeles, it ain't easy at the moment. Now, we all knew this, right? And we all know that margins are being squeezed due to the prices of higher inputs, both commodities that I talked about, but also capital. I don't know what it's like in your country. In my country, the Netherlands, prices of labor are going up quite steeply. Who's paying for this? That's a really good open question. All of this has its repercussions on our business, on trade credit insurance and on surety. And again, if I would go to sleep now, I would expect to wake up kind of depressed, right? Now, what do we see? Is that depression something that is justified? And somehow it is, because if I look at my members and I look at the ratio of country downgrades to country upgrades, they're about 10 to 1. We haven't seen this for decades. We have seen ultra low insolvency figures in most parts of the world, but we're seeing sharp rebounds, especially in the UK, especially in the Asian economies, which make us wonder whether predictions done a couple of months ago, and I'll come back to that, still hold valid. And apart from this, there's the regulator who is looking over us. And the regulator should be looking over us because we did learn our lessons from 2008, 2009. There is an institution called the European Systemic Risk Board, who's recently published a paper on trade credit insurance saying trade credit insurance is pro-cyclical, which means as much as that it feeds the fire, both positive and negative. Now, whether that's true in that vehemence, I tend to doubt. But that we are pro-cyclical in nature is probably true. Having said that, then they draw the conclusion, well, shouldn't we do something about these people? Shouldn't we start looking at the capitalization of those trade credit insurance companies and sureties in a market which is already kind of tough, right? The more capital you have, the more expensive the product is going to be. At the same time, we have a lot of influence of general banking regulations and the impending coming of Basel IV. What does it mean? It means financial institutions are becoming an ever larger customer group of ours. And if the banking regulators enable us, because this is a story of enabling, to do more business with banks to help us together with financial institutions to stimulate the economy, that'd be really good. Now, all of that, let's see some market tendencies. And the first one is a word of caution. We were called by Her Majesty's Treasury a good 9 months ago. And the message was very simple. We supported you guys through the COVID crisis. And we get this thinking that if, especially the trade credit insurance industry, runs for cover every time that there is something on the horizon, we're not sure this should be a private class of business. Maybe it should be made public. So please, ICISA, could you tell us to which extent at the start of the crisis and during the COVID crisis, those credit insurance head for the hills and cut their exposures quite drastically? Now, we were able to do that, and we were able to show that, firstly, at the end of the third quarter 2021, exposures were higher than they were at the end of 2019, that the dip was very, very small. It was way below 10%, and said, look, you have the tendency to make us a little bit more volatile than we are. In fact, we're not. Now, if we look at the risk appetite, there's a large difference between players. We've seen people come into the market, we've seen people leave the market. But if we look on the whole, and if we look at an excellent piece of research done by Aon, the trade credit brokers, underwriters are becoming more selective. They are moving up the quality curve. They are looking to support somewhat stronger risk, which is not really surprising, right? With all the headwinds. If your margins are being squeezed and you're not too strong to start with, you might not want to support that company to such an extent anymore. But let there be no doubt, there is increased capacity. There is sufficient capacity for everyone. There is a heightened demand for the product, which shows its value. And prices seem to be somewhat increasing, again, showing the value from the demand side of the market for this product. And none of this can be seen apart from the reinsurance side of things, where AM Best said that in 2023, there will be an 8% decline in general reinsurance capacity. General. That means property, casualty, marine, all kinds of specialties, life, health, everything. Again, AM Best said there will be sufficient capacity out there, but it will come at a price. And lines of business will compete for capital. So if a reinsurance company cannot make its money in, say, property, they will reallocate that capacity to lines of business where they can. Where does that leave us? Well, we're not sure. The proof of the pudding is in the eating, right? The large renewal season is per 1/1. But what we did gauge was the mood from the reinsurance rendezvous in Monte Carlo, where the prevailing mood seems to be that our lines of business have been so good to the reinsurance community, have been so profitable, that we don't have a hell of a lot to worry about. Yes, prices might go up because of the competition between lines of business, but for next year, there are no big headaches, no doubts that sufficient capacity will be there. What also determines the risk appetite is, and it was alluded to before, right? The uncertainty of financial information. Can you really trust a COVID balance sheet and profit and loss account? And the answer is a very clear maybe. And the other part of the answer is it cannot be the only part of the picture. We will need other information sources. And the market looks at companies like SCHUMANN to come up with those information sources to see, okay, where is the margin going? To supplement trade sector and country information, maybe scrub social media to get early warning indicators like they should be early. And what I want to touch here for the underwriters amongst you is the consequence of high-profile pulling of cover, and the consequence where pulling was not necessary. Now, do we manage limits as an industry? Yes, we do, and that's what we get paid for. So it is probably unavoidable that when a company is gently going down the drain, that an underwriter pulls limits, adapts limits. The thing is, the public perception says, oh, this high street retailer in the UK, for instance, that's been catching a lot of publicity lately, is going into insolvency because those bad credit insurers have pulled limits. Sorry, guys, it is the other way around, but we do need to be sensitive to public opinion and to the market. So it's probably not the way, not that we manage our commitments, we have to, but it's the way in which we do it. Probably a little bit more proactive. Just a couple of words on financial institutions as clients. In 1994, after the insolvency of Svenska Kredit, which those of you with the same hair color I have might remember, there was a paper published under the ICISA flag by a gentleman called Steven Sandberg, basically saying banks are deaf, don't touch them. Banks will only take you for a ride, they have got better information than you do, don't touch them. In the meantime, what we see is that banks have become very good clients of the industry, be it trade credit, be it surety, both of them. And banks are becoming ever larger clients for a couple of really, really good reasons. So to increase their lending capacity, if they're full on one of their strategic clients, they might look to syndication to increase their lending capacity. That syndication was with other banks. Now it is increasingly with trade credit insurance companies and sureties for regulatory capital relief. Because if they get some kind of, and let's loosely call it guarantee for the moment, from a highly rated credit insurance company or surety, they can decrease their capital accordingly. Now, you see the other 4 reasons on screen. The one I warn for is risk considerations. Most banks, the vast majority of banks, are interested in partnership because they see the value in that partnership. But we've got to stay wide awake and look whether we're not becoming the garbage bin to risks that the bank doesn't want anymore. And it started off with receivables in every shape or form. Could be factoring, could be supply chain finance. What we're now looking at is that banks are looking to cede loans to us. It could be a viable piece of business if done right. Loss ratio is healthy, and that is the proof of the pudding. With 346 billion of transactions facilitated, that's US dollars. Factoring is easily 4 times as large. And let's not forget, this is a major source of liquidity for the global economy. If we're looking to make sense of our industry and where we contribute, this is one of the main fields. So the part I have least figures on, and the part I have only anecdotal evidence, the current loss activity, it is slow to pick up. It is slow to pick up, but a lot faster than we would have thought just in May 2022. That seems ages ago now, right? One of our members published a piece of research that there would be a rebound for insolvencies in 2022 by 11% with regard to 2021 and 14% to 2023. Only a couple of months after, we see corporate insolvencies in the UK jumping by 52% year on year to Q2 2022. So very uneven prospects, both geographically and per trade sector. The pessimist, and that's the guy who calls himself a realist, right, says batten down the hatches. Bad times are coming. The optimist says this is the time to grow. And ladies and gentlemen, I think we're both right. Both the realist and the optimist have something to show for. If we don't show in these times, if we don't grow in these times, we're never going to grow. What I wanted to end you with is a 2-minute video, so Robert, indulge me by overrunning by a minute, to show you once again why TCI is so important. It is also a shameless piece of PR for the Trade Credit Week, which is going on in ICISA at the moment. We've paused for today to give SCHUMANN all the room for this important conference. Tomorrow it starts again. If you want to have a look on www.icisa.org. So with that, I leave you with this video. why is trade credit insurance important? And it would be really nice if I could start it. Here we go.
From my point of view, to attract fresh talent, I think we need data scientists, actuaries. We need a whole new range of talent in the industry, and we can't operate in a cave, so we need to open it up.
Trade credit insurance is a niche market. As niche operators, we tend to experiment and to embrace change even before it happens. We are curious about new technologies, and we like to set up non-obvious partnerships. So the world of trade is changing. By opening up to the world, we really lead that change.
You know, countries that are open to international trade tend to grow faster, innovate, increase productivity, and ultimately the people tend to have a higher standard of living. And trade credit insurance builds trust between the buyer and seller. And ultimately, if we open our industry to the world, we'll have more international trade.
It is important to open our industry to the world because TCI is an enabler for trade, both domestic and international, in an ever-increasing, complex and risky macroeconomic context.
Every region, people, and industry across the world trades in goods and services. While ensuring this trade is common in developed markets, we believe it is crucial in all markets to bridge the uncertainty of credit repayment.
It's estimated that only 20% of global trade is being insured. So there's a lot of room for growth for trade credit insurance in mature as well as in emerging markets, particularly in this current environment of high uncertainty, of high volatility. Trade credit insurance is only going to grow in its importance.
I believe globalization continues to create a governing growth for all parties. And that is why it is so important to have trade credit insurance in place, allowing businesses to trade globally and ensure they get paid. It is a great tool to safely access international markets while competitively promoting the product and services.
Thank you very much, Richard, for all the insights, and that was really interesting to see how the trade credit insurance react on the uncertainty in times. So thank you very much for your support, and it was great having you here again. And see you next time again at Schumann conference on site or any other activities we are together jointly. See us.
Thank you, Robert, and have a great conference.
Thank you.